Hi and welcome to another video on Forex trading. Today we'll be looking at price gaps, which are empty spaces on price charts that often appear after significant economic, political, or social events. These gaps signal fundamental shifts in supply and demand that could lead to new market trends. In this video, we will be exploring the nature and types of price gaps in the Forex market and how traders can apply appropriate strategies to take advantage of them. Let's dive deeper. So, first of all, what exactly is a price gap? A price gap refers to the space between the closing price of one time frame, like a day, and the opening price of the next. These gaps create empty spaces on price charts and provide essential information about behavior. Price gaps are classified into several types, each with its own significance. The first type is the common gap, which appears without any specific reason and is random. These gaps typically get filled quickly and don't have a lasting impact on the price trends. Then there is the runaway gap, which forms toward the end of a strong trend. This type of a gap indicates that the trend is accelerating and will likely continue in the same direction. Runaway gaps are often seen as strong signals of trend continuation, suggesting that a significant price movement is ahead. Another type of gap is the continuation gap. This gap forms in the middle of a trend and suggests that the trend will keep moving in the same direction. It is a great signal for traders looking for entry points during ongoing trends. On the other hand, exhaustion gaps occur at the end of a strong trend, usually near its peak or bottom. They indicate market fatigue and the possibility of a reversal. For traders, exhaustion gaps serve as warning signals of a potential correction or reversal. Now that you know the different possible types of gaps, you may be wondering why they occur in the first place. Well, several factors contribute to the formation of price gaps. One of these is news and economic events. Important data releases like interest rates, employment reports, or political crises can trigger emotional reactions from traders, causing these gaps. Market closures, such as over the weekend or during holidays, can also create gaps when trading resumes. Additionally, sudden shifts in market sentiment and changes in trend direction can lead to gaps, as can market manipulation, where large orders from powerful institutions or individuals may result in significant price movements in a short time frame. Thankfully, traders can utilize a variety of strategies to take advantage of price gaps. One common approach is the gap filling strategy, which is based on the belief that many gaps tend to close over time. The idea is to find significant gaps on the chart and trade in the opposite direction, betting that the gap will eventually be filled. Risk management is crucial here, so traders often place a stop loss near the previous reversal point and set a profit target at the end of the candle before the gap. Another strategy involves trading in the direction of the gap, assuming that the gap signals trend continuation. Traders looking to use this approach will find gaps that align with the primary market trend and trade in the direction of the gap. This strategy leverages the momentum of the trend and has a higher probability of success. Stop losses should be placed near previous reversal points, and profit targets are set at the next support or resistance level. Trading gap reversals against the trend is yet another approach. This strategy assumes that after a strong reaction to news or events, prices tend to normalize. Traders will look for gaps that form against the prevailing trend and trade in the opposite direction. If executed correctly, this strategy can capitalize on market corrections, as gaps often signal overextended price movements that may normalize. Finally, some traders use the filling small gaps strategy, which capitalizes on the tendency of smaller gaps to close. Traders can look for small gaps on the chart, set stop losses to limit losses, and aim for the gap to close, providing a clear risk to reward opportunity. To enhance gap analysis, traders can use indicators that are specifically designed to help spot and track price gaps. One such tool is the Gap Snake indicator, which is available through TrendSpider. This proprietary indicator tracks the most recent gap until it is filled or closed, helping traders identify potential opportunities. The indicator not only signals the emergence or closure of gaps, but also sets alerts for when price moves into gap zones. By combining this indicator with other technical tools like moving averages, RSI, and Bollinger Bands, traders can develop a more comprehensive understanding of market conditions and spot reliable trading opportunities. So, in conclusion, it is safe to say that price gaps are a powerful tool in technical analysis and can help traders make more informed decisions in the forex market. However, it is important to remember that gaps alone do not guarantee trend continuation or reversal. Traders should always consider other factors such as market volume, overall trends, chart patterns, and macroeconomic conditions to gain a clearer understanding of the market. By applying a well-rounded approach, traders can effectively use price gaps to their advantage and improve their forex trading strategies. I hope you have learned a lot today. Please write your thoughts in the comment section below. That is it for me for today. See you in the next video and happy trading.